It's been a wonderful session today from the morning time, and this is the third panel session on this forum, African Microfinance Conference 2023. We're glad to have you back again. This session is going to be about digital microfinance and risk management. I repeat it again, digital microfinance and risk management. So it's time for us to talk about the risk inherent in digital microfinance. And we have a good set of professionals who are into risk management to deal with the subject matter today. They are already set, and I'm pretty sure they're going to do justice to the discussion today. The moderator for this event today is my brother, Mr. Roderick Aye. It's nice to have you, Mr. Roderick Aye. The floor is yours. Thank you.
Thank you very much. Thank you once again. And good afternoon to all the participants and especially to the panel. I'm sending you regards from the beautiful Accra, Ghana city. And I know wherever we are today, whether it's afternoon, evening, or morning, we are having a very good time. And I must say that the second day conference is going on well, just as we experienced yesterday. I want to welcome all of us to our session, which is digital microfinance and risk management. You would all agree with me that risk is very integral part of microfinance. I mean, without much to say, I would say that the concept of microfinance actually evolves around risk. I mean, if you look at the client that we are dealing with, if you look at where they live, if you look at their livelihoods, each of this is somehow connected to some kind of risk. And therefore, we cannot be oblivion that we are working in a space that has no risk. And to talk about digital, I mean, we are excited that digital is going to give us some kind of the leapfrog that we need to really activate financial inclusion, for most people, and if not for all people, for the majority of the people, so we can sort of reduce poverty and improve the livelihoods of people using microfinance. Again, we cannot say that what we have in the digital space has no risk. It is aiding as well, but it has its own, risk lines that we have to take a look at. So largely, what we are going to do in this session is to look at how we can fuse or marry or blend digital microfinance and the issue of risks, which is central to microfinance. To do this, I have in the studio very resourceful and experienced team. I wouldn't say much, but I would give them some time to introduce themselves so that you hear from them themselves, and as well as to say hi to them. I am Roderick Ayer. I work for the Apex Bank. I consult and I train for microfinance, rural banks, as well as savings and loans or institutions that are interested in microfinance. So I think I'll start with William. William, how are you?
Afternoon. I'm fine. How are you?
Great. I'm good. I'm good. I'm good. I'm good.
And good afternoon, to the audience that is listening to us. My name is William Chileshe. I want to introduce myself from that point that I have 20 years experience in microfinancing and banking sector. Most of it concentrated on microfinance and risk management. I run a country at Credit and Collections. I'm a founder. Previously was managing Express Credit Zambia, which is an institution intrigued in managing and providing finance to a mid income earners and to those below the pyramid. I have 20 years experience, as I mentioned, and have been practicing risk and microfinance management for that long, and well equipped enough to deal with the finance and risk aspects of the digital age. that we are discussing today. I hope I've done enough introduction.
You have, you have. Thank you so much. I mean, it sets the tone for our conversation. Now, Doc, you are with us. So a little bit about
Yes,
yourself.
sir.
So yeah,
Yeah, I'm called Dr. Henry Clark Kisembo. Uh, I have been in the field of inclusive finance over 22 years now of practice, and this is within uh, microfinancing, microbanking, and technology, and delivering and deploying from analog to digital in the microfinancing space. But also, I'm involved highly in investment financing. So I work with Development Associates Link International, a regenerative and transformative growth and development consulting, project management, and investment facilitation firm, which is based in Uganda but operating in 101 countries on six continents. So I'm the group global lead and chairman. So I'm always on the go, on the move. I hold a PhD in financial economics and investment, and a second PhD in government finance and technology. I part time oversee graduate students, but my passion is so much being in the field, on the ground, dealing with solving challenges that humanity faces in the financial space. Thank you so much.
great, 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 great introduction. I'm sure our audience are ready to rumble or listen to us. One of the things that I can notice is that, I mean, we are dealing with panelists that have seen the errors of microfinance from the book, blog, digital face. And as well, we are having people who are much experienced with the field, with theory, and as well as with the practice. I want to say that we would have a panelist. When he comes, we'll introduce him. So, in our brief introduction and brief opening, do we see risks, traditional risks in microfinance, and risks out of digitization being the same or being different, or if there are, similarities? What do you have to say, William? Do you want to help with that?
Thank you so much. I think there will be a few similarities, but there will be a great difference in terms of how risk is applied in the digital space. Um, Unlike in the traditional risk management, where I would rely mostly on physical documentation, now we have the digital space where most of the data and most of the references has to be digital. So you find that we have new risks arising because of this space, that we will have cyber risks that needs to be contained. You have fraud risks that need to be contained, and you have the hackers that are always trying to implement ways of trying to steal and manipulate data. So there will be a different, the risks in this digital space is supposed to be dealt with differently from the way we dealt with risks in the traditional way of dealing with financial transactions and also offering services to clients.
Great. So what you're saying is that, I mean, they may be the same risk, but one would have a higher focus based on how they come and affect the institution and how they look alike. And so if I pick it from you, in the digital phase, we need to have our eyes open to some risks that actually look like the traditional, but has certain uniqueness that we have to deal
Yes,
with. Great, great.
yes, yes.
Doug, do you want to add to that?
Yeah, sure. My brother there is really very right and spot on that there is really risk going into digital. And actually, I think over the years, transitioning from analog, which is more of the book, to digital, I find that risk is even more or higher with the digital, because remember that we are moving all systems to get digitalized. For example, KYCs, know your client. So you're going to use a digital, you've never met a person probably, but you're looking at a credit score, or you're doing a KYC digitally. Chances of error stand out. So that is also a risk, which means that you can't totally delink a human being from the human touch from this. The other risk is based with the security and safety. For example, how do you get to trust the client? Because there are countries where they still don't have national identification numbers or IDs. They use work IDs and all that. So that can one can go downtown and come up with an ID. But if all the information is tracked on the national identity card, and it's swiped and information in your background can come out, that will help a lot. Identification of the person. So it needs both physical and digital. But if it goes digital, it means that we need to take it slow, but very critically, and understand that person's true identity. Hackers, like he said, are also not sleeping, because we are innovating day in, day out. But same as hackers, they're innovating day in, day out. That's why you find that the multi-level authentication is very important. But other than that, also it's upon institutions, the supply side, to ensure that the firewalls and approvals are also separated. What I mean, that one person can't be the only one approving a facility, like a product, a loan, for example. There must be like three people with a key to approval, but also firewalls, at least a minimum of four firewalls levels that can detect and show a red flag. Finally, just to cap this, is that in a country like Uganda, until of recent, when the Uganda Micro Institutions Regulatory Authority has been enacted into law and now is a regulatory authority, there was no credible institution uh, other than the central bank, which was overseeing these entities, but also the interswitch or interconnectivity was between banks, not MFIs. So if I could have a facility alone in about six of them, so I live a life of loans, get a loan to service a loan. It's a risk to all the six entities, but it's also not helping the purpose of me joining microfinancing or microbanking, because I'm supposed to change my life. My life is supposed to improve. But if I'm in debt at any one time, even my health is deteriorating. That is the demand side. But now with CRBs coming, I think that is going to be handled. So I would say that digital is good. It has its advantages, but there is risk, and we have to be very cautious about this risk for both the institution and our clients. Thank you so much.
Thank you very much. So we'll summarize to say that yes, RIC still exists in the digital phase, just as it existed in the analog phase. Actually, digitalization is giving us more consolidated and large, if I should put, kinds of risks that we have to take a look at. And they are so much interconnected within the digital space. Therefore, that actually also tells us that we have a lot to do whilst we celebrate digitalization as a medium to enhance financial inclusion. My next question, if you look at the realities on the ground when it comes to microfinance management, I would say we have not been too well, or we've not done too well when it comes to risk management, because the core of most problems of MFIs boils down to weak processes that could not help them reduce or prevent risk events. Going into the digitalized phase, how do you think MFIs must reposition themselves when it comes to accessing and developing risk mitigation factors to manage the context of risks in the digitalized phase? So how do we go around it? William, we have something on our hands to deal with
Yeah.
now.
Yeah, so thank you so much once again. So with the coming of digital space, as we've said, we realize that in a way risks will increase because it's a global world. So hackers will have all these platforms just as we do in terms of their planning. So microfinance institutions who need to develop a clear internal controls that ensures that risk management is enhanced. The microfinance institution need to have frameworks that ensures that they can detect risk from the processes that are being built in how they offer services to the clients. Most risk should be before even the process of giving a facility starts, because at the time money goes to the customer, at that time the money is lost. So it should be that the process is able to first be able to give you hints of what could go wrong and how that could be mitigated. So risk framework needs to be built first, both from, it's a digital space. So when we say build the risk frameworks, we are saying the systems being developed should have the embedded risk management already built in that system to ensure that the institutions are able to detect even beforehand what could go wrong with the process. And also that the systems being developed, as the doctor said earlier, must have a multi-factor um, identifications that are able to give you clear aspects that your products and also the processes are free from intrusions if you are to get to a point where your services give you back the profits intended. So with this, we have to say from the inbuilt, do we have what we are able to see from the clients that we are bringing in the systems? This would mean, are we able to identify the customers from the first point? Do we have the risk profiles that are able to identify who is our right customers? That identification need to be built in the system. We also have to look at who are they in terms of what risk profiles should we build in the system that are able to identify who the actual customer is. These will speak to things like fingerprints. If you are able to have an inbuilt that the banks do have, where you are signing, instead of signing you can just put in a fingerprint and the system is able to recognize that you are the actual customers. And we also have to look at what are you able to see, and these are things like passwords. Can the systems incorporate these identification processes that are able to make sure that we do have encryptions that do not, customers do not end up having their passwords exposed and all that. So we do have a lot of work, and most of it will have to be done on the platforms that we are building, but also ensuring that there is enough sensitization to our clients in terms of the levels of risks that they should, the layers of risks that they should be able to detect from their end and avoid. And this leads to requiring that in the systems we are building, there should be some level of literacy campaigns being built to ensure that customers can regularly receive updates on what is happening in terms of these risks that may actually affect their access to the services that we are offering.
Yeah, thank you, my brother William. If I could understand developing the framework for REX, which is very vital. I see a lot of focus more on detecting who the client is, which is the risk profile in which we have done, and then what risks they bring on board. Doc, I want you to look at something. We have looked at the beneficiary side, which is developing the risk profiling of our clients, knowing who they are, ensuring that, I mean, the credit they are taking, they are able to be analyzed. Can we look at the other side of the framework, which is more on the institution, which is the MFI, which is the microfinance institution? Because, of course, you agree with me, the risk element, the source can come from the client, it can come from the institution itself. So how do the institution themselves reorganize themselves to focus on themselves to ensure that, you know, they develop systems to manage the internal risk? Thank you, Doc.
Yeah, so basically, let me pick it up from where a colleague left it at, that in order to have uh, an institution which has planned, which has a clear plan, like has been highlighted, done all the risk profiles and all that, the starting point is to consider uh, conducting a technological readiness audit of the institution. So you don't just desire and jump into technology because it is what everybody else is doing. You need to understand, do you need it? And if you need it, why do you need it? How is it going to improve your services? How is it going to enhance operations? How is it going to lessen the laboriousness of work? You start with that. Once you agree that yes, and this should not be a one-man decision, the founder or the chairman, all stakeholders should do, whether it's the chairman, the founder, the board, the MD, even staff, all of them have to agree and appreciate it. When they appreciate it, then uh, they will know the importance, because operational risks mostly come because people don't appreciate digital age or technology that has been brought on. However, once that is gotten, it should inform what we call the RFPs. We put out RFPs there, requests for proposals from digital entities, companies, to come and give us on-board platforms. But before that is done, we need to consider conducting what we call technology audits. What is the current technology that we have? Conduct an audit on it, and then also conduct an audit on the technology that is being brought. This means that as an institution, you don't just onboard and roll out. You must go through a certain phase. There is a phase of uh, after procurement, you've onboarded a system. You prototype it, have dry run tests, then go into a second level of prototyping with a smaller group internally. Then pilot it and test it with a few clients. And as an institution, you're trying to see where any loophole is. Actually, there is what we call there's what we call, normally we call them holy hackers. Why we call them holy hackers in our field is because if you can hack into a system, which means a hacker out there hack into it. So you must test it with what we call holy hackers. Try to hack into the system. If they hack into it, then that system is a risk to the institution. That now brings in the issue of firewalls and all that. So basically, I think the word here is conduct systems and technological audits to be aligned in light of risk and ensure that everybody who is a stakeholder, internal stakeholder and external stakeholder, are party to this process. And in that way, we can address this digital risk, because incidentally, that we are into the financial sector. When the risk happens, we don't want to be caught off guard, to be reactive. We want to be proactive. That let's try to have assumptions, a hypothesis
Okay.
of what could happen. Yeah.
Yeah, that's great. Great. So what I gather from our conversation is that one, institutions needs to build the right risk framework that speaks to their needs. Then when you finish building, don't leave it there. Implement the framework that you have built. And finally, make sure you conduct audits, rerun audits, to ensure that the systems that you have built are well fitted solving your problem. So it's important for us as institutions to build a framework focusing on clients, focusing on ourselves, focusing on the regulator, focusing on the economy. Then we implement the framework that we have built. Once a while, quarterly, monthly, yearly, we conduct our audits to ensure that the systems that we have is working as required. Thank you very much, my kind panelists. Now, let's look at big data. Big data. How do we bring big data, largely data analytics, to help us manage some of the risks that we've spoken about in our industry? How do we do that? With a mindset that whilst we are thinking about risk, we are also thinking about the objective and the impact of microfinance. So how do we bring big data and analytics to help effective risk management in MFIs? Yes, William.
Thank you so much. As we go by the digital space and all that, obviously the biggest key element is trying to make the financial services easily accessible to our clients. I think in this age, we have realized that traditional banking and traditional microfinance has left out a number of people that should actually be benefiting to the microfinance services and to bring more financial inclusion in the economies. Now, because they are at the bottom of the pyramid, we do find that in most cases they do not have a financial history or credit history that should be referred to in order for them to fully be included in the financial system, the traditional financial system. And then now comes the big data, which is now the more or less like a platform that can be used to look at the patterns in terms of user profiles, how the individuals have been using the mobile networks and their spending power and all that, to try and create some sort of capacity that they take with them, and that can be used to more or less like help them with some credit facilities and give them some credibility, and without relying on the collateral as it has been with the traditional banking. So that big data topic is a big issue because it sits in the middle of how we should assess the people at the bottom of the pyramid, those that haven't been included in the mainstream banking. And therefore, institutions would require to build in platforms or to get into partnership with engines that are able to analyze the data and give them the understanding of how each individual that they are looking at is able to afford the services that they are able to offer. So big data is a big issue. It's a big issue that we should be looking at as providers in terms of how we can use it to develop and help the people that are marginalized, that are not able to access financial microfinancial services from the mainstream. With big data, it means that we also have a bigger reach. Because in the traditional banking, mostly you wait for the customer to come through and then you'll be able to, there is marketing, but if you look at the big data, it means you have in an institution, in a country, you can easily have the entire database of whoever has lodged on the system, on the internet, and you should be able to look at what their spending patterns are or their use of the internet. And you could see that the mobile, the MNOs are using these as a basis to offer most of the services they're offering. And it's beneficial for microfinance institutions to tap in there to enhance their digital microfinance services provision to their clients.
Great, great. So, I mean, big data is important and data is all around us, but how to mine and analyze this data is what we are talking about. So, platforms built by the institutions themselves, or they can fall on partnership, like you said. And then as well, sometimes government and agencies are also helping to, develop the right framework that can help, gather data for the institutions to mine. So it's important that we accept the fact that data is all around us. What we need to do is to develop systems that can help us tap into the data, whether it's how they are using their mobile phone, how, I mean, consumer items they are purchasing, are they paying, and the other loans that they are taking. So all of this, we can make good meanings out of it. So while we are talking about the risk event in there, there's also some solutions that we can leverage on. Doc, I wouldn't worry you on data, but one important thing that is it's a problem is fraud. I know of an instance where, a digital platform, was somehow crippled because of fraud. I mean, some few people begin to turn around the inflows amongst themselves to create a good, sort of deposit history. And at a point in time, this few friends goes to the digital platform and borrowed. So they borrowed with fictitious sort of, analytics. My question is that how do we deal with fraud in the advancement of digital finance, to save microfinance institutions as well? Thank you, Doc, if you can help us.
Yeah, thank you so much. And I would again relate it to the previous speaker that there are a number. Big data is great because it gives you greater variety, like James has said, but also I think it gives more velocity. Now, variety and velocity is good, but it is so complex in such a way that when analyzing, separating good from bad can also become a complex issue. And that is where loopholes start coming in. The beauty of it is that we've been talking about multi authentication because big data should no longer be only about personas, the name of the person, what they do, their age bracket, but also go ahead to capture biometrics because no biometrics will be the same in the world. You get it, like the thumb, the finger
Yeah.
biometrics. That should be part of that big data. If it means capturing the eye, the iris, that could also help a lot because it's really so bad that something so good turns out to be a problem. Big data should
Yeah.
actually ease
Help us.
up,
Yeah.
but it has now turned out to be a problem. Institutions are losing monies they can't even declare in the public
Hmm.
because
Yeah.
it can shock the public.
Hmm.
They
And lead to
just
reputational risk.
leave it, to mitigate the risk, they leave it at security level of the country and within the industry regulation. Because if you bring out such information, your clients and the country can just go into a shock because these are huge monies. But the people involved in this fraud are the analysts who are creating duplicate accounts and then channeling, now routing funds into these ghost accounts, because now we call them ghost accounts. They
Hmm.
actually, there is me times five ghosts now, but all of them are getting facilities, and in the end the five ghosts disappear and I remain alone. So the five ghosts disappear, and that is an abuse of big data. But also, I think to be able to give confidence to whoever you're collecting data from, you don't forget the consumer and personal data protection, either policy within the institution or even aligning it with the laws of the country, but also international protocols. And then we can be able to combat this fraudulent act. Because some, like you rightly said, Mr. Moderator, that it is an inside plot. Nobody comes from outside to manipulate data. It has to be inside. But the beauty is that security systems are being developed to combat that. But also information saturated. Thank you.
Great, thank you. So velocity and variety. I mean, digital phase is bringing us. It's so beautiful, like you said. But if I put in word, you say that it is good, but we should watch the gap, because while we are analyzing this, we can leave out a loop, and this loop becomes our downfall.
Yeah.
So yes, big data should help us get velocity. Big data should help us get variety, but we must put them in the right perspective with the right protection and the right analysis to get
Yes.
the right results. Other than that,
Yes, sir.
it will be so great. Now, talking about fraud, we've talked about the concepts and the risks that is arising out of digitalization. Let's look at this monitoring. How can digitalization help us monitor and as well as help us achieve the objective of financial inclusion or microfinance? Remember, we are risk, and whilst we are in our typical world, we are always looking at what may go wrong. So we want to take a little bit shift from what may go wrong, how we can manage it, and still be focused on achieving our goals when it comes to financial inclusion. So how can digitalization help us to do effective monitoring and as well help us achieve financial inclusion? How do we go around it? I want to start with Doug, and then I'll come to you, William. Doug, so you can
Oh,
help
thank
us.
you. Yeah, thank you so much, and thank you, William. Sorry, I called you James initially,
Yeah,
but
You used
yeah,
to.
yeah,
that's
but
okay.
yeah. Let me say that you see, the reality is that in order to develop a risk mitigation plan, you
Hmm.
must have assumptions that what's the probability of A, B, C, D, E happening? Is it low? Is it medium? Is it high?
Hmm.
So you rank it. Now, these assumptions, for example, must be having variables or parameters. For example, a PIN code. If a PIN code falls, if a gadget falls in the hands of a wrong person, the PIN code, the wrong person is going to, you're going to detect, you set the system in such a way that if 3 times entering a PIN code, which is wrong, block that gadget.
Hmm.
No more functionality until they report, because that is a detection there is something which is not right happening.
Okay.
So this is part of monitoring, but also there is a mass volumes of money at certain hours. That's why there is a regulation on how much money you can have on a mobile cell phone as an individual, as a business, as an enterprise, and how much you can able to, because we talked about the profiling. So the profiling will also show what volumes are moving. That's also an assumption. If you see huge volumes, intermittent within, say, 2 or 3 times large volumes, it should create a red flag and say something is happening which is wrong. But you don't want to wait for this wrong to happen. So you create a dashboard where you've put, you're having viewership.
Hmm.
Say the IT security team is having viewership on all transactions. They have codes. You're on the system. And then there are pointers where you put a red flag. It can communicate to the loans officer. the manager, the accountant, and other officers. There is a red flag on this account. Act on it. So that is part of monitoring on the digital platform.
Yeah.
So, but my colleague William could also probably
Great.
add
Great.
on. Yeah.
So William, thank you, Doug. William, please add on.
Thank you, Doc, and thank you, moderator. I think monitoring becomes key in our digital space because now, first of all, by using big data and these digital platforms, it's easier for us to actually have a real-time kind of monitoring because we can actually have a platform that is able to pick from the data input and to the back office where we can actually see what is happening. So what would be important in this phase is to ensure that first there's continuous monitoring. If we can have a real time, most institutions have to invest in real time processes that ensures that there is at any particular time you are able to see what the input is and what the output is, and then using encryptions and files, you should be able to see areas of intrusions because under data protection, you'll have areas where you'd say in this data room, there shouldn't be maybe access to this type of data. So at a particular time when you see intrusion against that where you've the protected data, you should be able to raise a flag. But what will be key is continuous monitoring of the processes. As we said earlier, that there should also be a continuous audits of the data that we have and continuous backups also to ensure that there is no data loss at any particular time that can infringe on customer information that we are already keeping up. So regular reviews, continuous monitoring, and real-time systems that can actually alert and provide feedback from the input to the backroom. Those will be key in terms of monitoring the data.
Maybe just to add on a point or two is that there is what we call frequencies. So we have frequencies of three, I mean in hours, that every 3 hours there is likely to be an incident. So every 3 hours you must check in, check in, check in. At times you even turn off the system when you realize that an incident is about to happen. You turn off the system and there's a downtime. But I just wanted to say that to all those watching us and listening to us, please, if you're an institution, don't wait for beyond 24 hours, beyond 12 hours to do reconciliations. Conduct reconciliations on a daily basis, no matter how laborious or taxing it will be. Because the day you go into 24 hours, you may come back when you have a clean sweep of a branch. So daily reconciliations, daily reconciliation. Thank you.
Good. So thank you for our advice, and I hope we've all taken notice of that. And then I want to add that in terms of the monitoring, it goes more even beyond just maybe our loans. It can monitor staff work. It can monitor back office work. It can monitor our financial levels, our operational levels, even our compliance levels, as well as what he talked about in terms of the reconciliation. So the digital platform actually provides, if I should put it, more of a 360 help and support for MFIs. It's about how we utilize them, we capitalize them, and we create the functionalities to manage the risks that we talked about. Briefly, I think one of the things you all forgot was to look at where does this take us in terms of the financial inclusion? Where are we heading towards to? Do we see inclusiveness ahead of us with digitalization? and how do we manage the risks aspect of it, and then our objectivity. What do you want to say about that? William, first.
Yeah, so obviously with the digital space and the financial inclusion, the whole idea is to try and bring in people that we could not provide services to in through the traditional microfinance services. Now, with more highlight in terms of identifications, in terms of understanding their spending patterns and their use of these platforms, we have now the capacity to bring them in and be able to have them included in the financial streams using these digital platforms and microfinance services that are being offered. Because in the traditional, as World Bank indicated in the previous report, that it is more 25% of the people, it's more likely for a former employed individual to access credit as compared to a person in an informal environment. So with the inclusion now using the big data, and also that we are able to identify individual capacities, both those that are on top of the pyramid and also those that are below the pyramid, it helps us to have them included, because we can now specify and be able to create products that fit in their credit profile. And we can also provide them with access to saving facilities, access to insurance services, because we now have the capacity to identify them to their potential, at the point of their potential, which becomes very key in terms of financial inclusion, because now we can actually be able to reach out to all the areas, including remote areas, and be able to provide whatever the needs they are based on their potential.
Great, great. So, Doc, any predictions? Are we
Yes,
hitting the objective, right?
yes, we are, sir, because let me be frank here that
Yeah.
I have been at the forefront of financial inclusion for 2 decades. And I can say that it narrows down to the individual, the family, the community, society, and the nation. If I can entrust you with my vulnerability, then it means that I am ready and prepared to take what you're bringing on to me. What do I mean here? What I mean is that a key to financial inclusion, and why you find that despite the different technology that has been deployed, the uptake and adoption, there is still a lot of work to do for microfinancing and digital microfinancing, because there was an aspect which was left out, a gap, which is trust. Once the demand side, the hard to reach, the underserved, the vulnerable, because by the vulnerable, Mr. Moderator, are not only in hard to reach slummy
Yeah.
places,
Yeah.
even in the corporate, I could be up there on floor 19, but I'm
Yeah.
vulnerable. You
Absolutely.
get it?
Absolutely. Yeah.
Yeah. So it's not just for. So when we're talking about financial inclusion for all, leaving no one behind, if I use that slogan,
Hmm.
it means that everybody who's vulnerable, but also putting into consideration the underserved. I might be vulnerable, but I have access, easy access.
Hmm. Yeah.
But the underserved, and all of us together, the key issue is trust. If we build a relationship based on trust, trust me, whatever product you bring, I'll know that it is well intended. If there is no trust, that is a risk to financial inclusion or inclusive finance going into the future. And to trust you, you must secure me. So you can't secure me when you yourself you're not secured. You get it? So
Yeah.
secure yourself as an institution, secure me as a client, then create a relationship. I build trust, and microfinancing will hit rock high on delivering financial inclusion for all going forward.
Great. So
Thank you.
if I really get you well, what we are trying to say, which I agree, is that in spite of the digitization and the platform, if we're not able to create trust and we are not able to create security for our clients, then we would definitely not be able to achieve our financial inclusiveness, because
Exactly.
we would need our clients to uptake and adopt the product that we serve or we deliver on the wings of digitalization, which is very, very important. So one of the things that I think we should be cautious about, I mean, if you look at our development phase, when there is an error, we get so excited about the error, and then we run with the error. Then we have to still go back and realize that we have not been able to achieve what we intended to achieve in the era. I mean, the phase of microfinance, and now we are talking about digitalization and microfinance. I hope digitalization and microfinance management will help us achieve a lot when it comes to inclusiveness, so that by the time 10 years we are talking about again, we are talking about how to build on the gains that we have achieved as a sector or as an industry, rather than still be talking about vulnerabilities, underserved, and all the other people. And I think that once we're able to, create the necessary trust, create the necessary security, create the necessary product on the wings of digitalization, then we'll be heading towards somewhere. Because digitalization alone, in the context of our conversation, will not take us where we intend to go. So I want to ask all our audience, wherever they are in the world, if they have their questions and comments, they can type it and then they can share in the conversation that we have. We are actually wrapping up.
I just
Uh,
wanted to add a point, sir,
good, good,
that
do that.
it's good you brought out the issue of errors,
Yeah,
because we are right now in the digital age, and the digital age is also segmented into different parts: blockchain, AI, all these. So we are in that era.
mm,
But like I said yesterday, and I also today morning, well, in my keynote address, I said we should not lose the purpose of why
mm.
microfinancing came to be.
Okay,
It came to be in order to transform people's lives for the better, move them from
agree.
one point to the other.
Other. Great.
It doesn't matter how much I earn or another, it should move me from one stage to the other, because we are at different
Absolutely.
stages. My vulnerability, let me say this out, and it may come out as ironical. My vulnerability may be $100,000 to get my goods to do cross-boundary trade. You get it?
Yeah.
Another person's vulnerability may be $100.
Yep.
How does microfinancing move us from that stage to the other?
The
That's the
next one.
vulnerability I'm talking about.
Yeah.
How do we get served to move from one step
To the
to the
other.
other?
Yeah.
That is the sole purpose of microfinancing and why it came in as an
Absolutely.
alternative
Absolutely.
to traditional banking models.
Yeah.
Thank you so much, sir.
Great. 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 So we must
Just add before we wrap up in
go on.
terms of one area that goes well with the risk management in terms of how we build it from the supplier point of view and to the customer is that it is important to look at the customer centric from the customer centric point of view because the risk profiles we build should be associated with the type of customers that we are trying to serve. So it's very important to look at how we create the products for the nature of the market that we would want to serve, because then we would position ourselves better in terms of the products and also the risk that we are supposed to manage as a microfinance. And also building within that we can have that capacity to tailor-made some of the products in order to ensure that financial inclusion is more inclusive, because certain products do not cater for certain class of clients. So I thought that I should just bring it out that a product creation and much more a focus on the customer centric needs, it might help in terms of how we digitalize and also manage risks that help financial inclusion.
Great, great. Thank you very much. So, the point of note is for us to customize or tailor make product in response of the profile and the needs of the clients that we are dealing with. I mean, the off-shelf products all over. I mean, and then also we need to look at varieties in terms of the array of product that can be available to solve the needs of the clients beyond just savings and loans. I mean, there are other needs of the clients that we have to take notice of. And I would say that we need to be thinking about progressiveness. Like Doc said, is from one level to the other. If we have a microfinance that is actually making people go back deeper into poverty, then we need to review those, progress or the programs that we are implementing. Because whatever there is, we need to ensure that this industry is providing progress, moving clients from one level of vulnerability, let me put it that way, to another level of vulnerability. Because in context, we are all vulnerable at a certain point. And therefore, what we need to do is to improve or lessen the vulnerabilities as we go along. You would agree with me that the financial sector for most African countries are well regulated. We cannot have this conversation without looking at and thinking about regulation. What do you have for regulators in the digitalized phase? How do regulation come in to create the necessary impetus that would create positive disruption to help us get to our goal? Because you and I would agree with me that regulation can make and or make the object of financial inclusion. So how do regulators position themselves in terms of digitalization to aid this era? William, whilst we are
Yes.
trying to summarize,
Yeah,
yeah,
you are right. I think one of the challenges that the regulators deal with is the speed at which things evolve in the digital space. So normally they lag behind in terms of how to keep up with it. So it would be important that the institutions that regulate work in collaboration with providers of these services in developing a regulation that ensures that it moves with pace. Because I think you would agree with me that, as you have said, that we would be at a different level if the regulation was moving at the same pace. But in doing this, they also need to be careful to ensure that they don't introduce regulation that in the process hurts the industry and also the consumers. So it's a big challenge that we all have to contribute. I was saying in the previous session that issues of regulations are issues that we could be bringing to these platforms and see how best we can contribute and help regulators in terms of catching up with the pace of the digital age. So within the regulators institution, I think it would be important to see how best they can include from the industry some of the key players in trying to make sure that whatever is coming up, they are at pace and they are able to ensure that they don't lag so much behind. I think that's one area that I would say that the regulators needs to do to ensure that they are not so far behind at any particular time. Because even as we speak, I think most of the things that have developed over time, regulation is not very much in place.
Yeah. Yeah. So regulators must come on board. I mean, I've seen quite some, work on regulatory policies on the fintechs, digitalization here in Ghana and elsewhere. What we need to do is to have regulation that really understand the era, so that they don't also stifle the progress, and as well address the key challenges that needs to. Doug, do you want to add on that? Being in
Yeah,
the
as
field.
in a brief, I would say that speeding up very pertinent for those countries where they have not yet gotten it. But the way to speed up is to enhance and stop policing and being an enemy of the sector, and the sector fears you. Collaborate in a friendly manner, and then they'll inform you what is happening. There is the process to enact a law is really a long process
Yeah.
compared to the pace at which technology is moving. But a financial regulation acts or laws start with a partial law, that
Yeah.
these are rules and regulations which will guide. So these rules and regulations, before they pass to become law, they can start being active. But how do they know? They will know from collaboration. For example, I work with Dali. I am from the private sector. I am in the sector, financial inclusion and digital technologies. But I am the current outgoing chairman of the mobile financial services at the Central Bank of Uganda. And hopefully I'm going in for a second term, maybe, maybe no. But at least that shows that from the outside, entities have been brought on board. Same with the UMRA, the Association of the Regulatory Authority of Microfinance Institutions. It's bringing outsiders to sit at the table and form technical working groups. In that way, regulation will not be seen as a policeman or to policing, but it will be collaboration for the good of the institutions and for the protection of the clients. Thank you so much, sir.
Thank you, thank you, thank you, thank you. Great, great views from great people, not only professional but passionate about the sector and the progress that we are making and contributing towards building an Africa that we all can be proud of from wherever we find ourselves, Uganda, Kenya, Nigeria, Ghana, and what elsewhere. Your final words, my gentlemen, for the sector and for Africa. William, to start with, we are wrapping up.
Thank you so much. I think in wrapping up, I would say that I think we should, both the sector and the regulators needs to embrace this movement, because I think this is the next big thing, if it's not the big thing already.
Yeah.
I think there's no alternative in terms of how we can become an inclusive society apart from going digital and being able to have everyone financially included. This is the only way that you can be sure that you are able to uplift lives that are in poverty, and also being able to service the communities better, because it's now understood that, first of all, this is one way of reducing costs of doing business, and also helping institutions to ensure that they can service and reach out to areas where they feel that they have capacity to save. Unlike in the previous past, where an institution can be concentrated in one area because that's the only area they feel they are able to service based on their cost profiles. So I think that it's come at the right time that we should be embracing technology as a way of economic growth and alleviating poverty in our regions.
Thank you, Doc. Your words.
Yes, my parting words is digitalize, but don't forget the purpose and the security within the digital microfinancing. And this takes into account the socio-economic growth and development of the institution and our clients or members, but also profitability, because we don't want to run down businesses. We don't want to go down the drain, because we are targeting to be so humanitarian driven. We are businesses. Profit we can't delink from profit. There should be viability. Are we taking digital products which are viable to the marketplace? Scalability, how can we scale this into other areas or geographies within the community or the country, or even trans-border or trans-boundary? Then interoperability, very important, that we should have systems with open APIs to enhance interoperability. Gone are the days of competition, seeing each other as competitors, but let us leverage on each other's comparative advantage, however much we're in the same sector, and then synergize. Once we synergize, it will even combat all these issues of fraud, slowness, everything which has been associated with our sector, microfinancing. So those are my parting words. Digitize, don't forget the purpose and security. Thank you so much.
Thank you, thank you very much. So after your summary, I have nothing more to add, just to say that we are in a great era. Let's take advantage of the era, ensuring purpose, ensuring security, so we can build a better Africa using technology, driving microfinance. Thank you very much, and thank you to the platform for this wonderful conversation. We are off.
Thank you so much.
Thank you so much, Dr. Clark. Thank you, Mr. William, and thank you, my brother Rod. It's nice having you. Actually, I don't really have anything to say, because you actually dealt with the matter with ease. It was as if you were on a breakfast or table and talking over the situation. So thank you so much. It's wonderful having you right here. To our listeners and viewers across the world, we're going to have a short break before we have the last session for the Africa Microfinance Conference 2023, which is actually going to be centered on customers. So stay tuned, and we'll be back shortly. Thank you. You all have a beautiful day. Thank you.
Thank you.